Hello, I'm Killian Nolan, Head of Product for Cantor Fitzgerald Ireland. I'm delighted to welcome you to our inaugural quarterly markets update, where we will take a brief look at investment markets with our market-leading asset manager, Merrion Investment Managers. Today, I am pleased to be joined by Fearghal Lawlor, Head of Business Development with Merrion Investment Managers. Hi Fearghal, how are you?
Hi Killian, all good today, thank you.
Great. Fearghal, as we've passed the halfway mark in 2021, how have markets performed year to date?
Really pleased to report at the midpoint of 2021, global equity markets have performed very strongly for investors with very impressive gains. As at the end of June, the MSCI All Country World Index is up about 15%, giving us one of the strongest starts to a year on record for equity markets. This has been achieved against a backdrop of optimism around vaccine rollout, significant monetary and fiscal stimulus, and with economies reopening, all having a positive impact on global growth. Inflation became a key topic of debate in the first half of 2021, given the huge level of fiscal and monetary stimulus in response to the crisis, coupled with the inevitable supply chain related bottlenecks as economies reopened. US Federal Reserve Chair Jerome Powell reiterated what he's been saying for some time, that the inflation blip will be transitory, with similar comments from the ECB also. We've agreed with this view and note there has been a shift in Chinese policy, which initially cooled credit markets, but has now spread from everything from cryptocurrencies to commodities. Latest US CPI data implies we are on the balance of probability past the peak of inflation scares in our view.
That sounds very positive, Fearghal. Thanks for that update. And how has Merrion Investment Managers performed for the first half of the year?
Yeah, delighted to report the Merrion MultiAsset fund range have continued to outperform both on an absolute and relative perspective, Killian. As you'll see on the chart there in front of you at the minute, all three funds have seen significant growth in the first half of the year, building on the outstanding success of 2020. Left to right there, the lowest risk fund, the MultiAsset 30 fund, is up about 5.6% year to date net of fees. And in this fund, we can hold growth assets typically in the range of 20 to 40%, and that's typically in equities, with the balance of the fund invested in defensive assets. The MultiAsset 50 is up 9.5%, and the 70 fund, as you'll see there, is up 12.9% net of fees over the same period. Look, what's really pleasing for us is this strong performance, both absolute and relative, means that the multi-asset funds and their underlying constituent building blocks, such as the Global Equity Fund and our absolute return fund, the High Alpha Fund, fall into a very small group of global funds who've actually outperformed this year and last. An achievement, I think it comes to less than 10% of funds globally have achieved that. So a real plus for the investment team. Look, when we look at the multi-asset fund, it's returned, as I said, just almost 13% for the year. This versus its benchmark of being up 11%, so decent outperformance on that first 6 months of the year. But also what I'm really delighted to announce today is the 70 fund has been ranked the #1 performing fund in the Aon Hewitt multi-survey across year to date, 1 year, 3 years, 5 years, and 10-year basis. And that survey includes 40 similar style funds managed here by both domestic and international fund managers as at the end of June. So that's a real strong endorsement for the investment team again. Under the bonnet, when we look at things, the Global Equity Fund is up an impressive 17% year to date. So really, really strong returns for a 6-month period. And that's as against its benchmark being up about 15%. And the High Alpha Fund, as I mentioned, our absolute return fund, it's up about 14%, building on last year's performance of just shy of plus 30% in a market where its peers continue to struggle to generate any returns at all. I suppose, look, one of the key differentiators that stands us out is our investment process, where we are active managers and style agnostic. We feel this is critically important in our view, given the number of swings in markets. Cyclical stocks last year had a strong run post-vaccine announcement in Q4. The funds benefited greatly from our overweight positioning. However, this year we rotated out of cyclical and low quality stocks as the global economic and earnings cycle peaked as economies reopened, and transitioned that into high quality and structural growth themes. Throughout June, this has paid off, and we have seen a stark reversal with growth stocks now strongly outperforming value, thus really highlighting the benefits of our style-agnostic active investment approach.
That's great, Fearghal, to hear that the funds are doing so well, and especially the the multi-asset 70. That's Aon's over 1, 3, 5, 10 years. That's a phenomenal achievement. So congratulations.
Yeah, look,
well done.
Yeah, look, really pleasing to see that consistency of return over such a long period. So delighted for investors. Yeah.
What's Merrion's outlook and positioning for the next 6 months?
Yeah, look, Killian, I suppose our medium-term outlook remains very positive, and it has been for quite some time. As highlighted earlier, I suppose concerns around inflation are somewhat understandable given the huge fiscal and monetary response we've seen to the crisis, coupled with the inevitable supply chain-related bottlenecks as economies reopen. Look, what we're looking at is as tapering of asset purchases approaches, as fiscal policy becomes a headwind to growth, not a tailwind, and as supply chain disruptions dissipate, inflation should decelerate from here. We also are looking at global bond yields trending lower, and the relative attraction of equities improves on the back of that. All positive signals for us. We are, though, positioned for potential summer volatility, which provides us opportunity as active fund managers. How we're entering the second half of 2021 is that we're positioned marginally below the neutral point in growth assets. So again, back to that 30 fund, it's at that in and around that 30 level, within that range of 20 to 40. And that's mainly driven by short positions in commodities, reducing the overall growth asset exposure of the funds.
The multi-asset 30, Fearghal, must be getting a lot of traction with investors now looking for an alternative to deposits at this point. Would that be correct?
Absolutely. Look, level of deposits, they're at all-time highs domestically here and globally. People are searching for yield, with the inevitability of negative deposit rates coming down the track. It's already hurting us, I suppose, from a corporate perspective. Absolutely, clients are looking for some sort of a yield, and the returns on the 30 fund are decent. I mean, as I said, 5.6% after fees for the first 6 months of the year. Some diversification into that type of strategy has been certainly seen or evident in the market.
Thanks, Fearghal. I'd like to just thank everyone for tuning in today. And if you have any questions, please contact your relationship manager. They'd be delighted to help.